What if I told you that the ultimate stock market squeeze is quietly building right under our noses? NIO is no longer just a struggling startup. It is coiled like a spring with a massive 5.50 resistance wall, exhausted short sellers, and a highly profitable 697 horsepower flagship SUV launching soon. The pressure is building, and it is ready to break out. My name is Mark. Watch till end. Please like and subscribe for more update. I will start with the fundamentals because for the last 2 years, the narrative around NIO has basically just been about survival, right? Exactly. The narrative has been survival, but in my view, that narrative is officially shifting to operating leverage. The core of my bullish thesis right now is that the broader market is entirely mispricing NIO's upcoming growth phase and its absolute dominance in infrastructure. Let's look at the immediate horizon. May 2026, Q2. NIO is preparing a massive double catalyst product offensive. They are doing the official rollout of the Onvo L80, and more importantly, their highly anticipated flagship, the NIO ES9. Right? The ES9. I've seen some of the leaked photos and the spec sheets floating around. It looks huge. But how does that actually move the needle for a company that has been struggling with margins? It moves the needle because of who it targets. The ES9 is a massive 5.37-meter, 3-row luxury electric SUV. They are explicitly targeting high-end business users, and the specs are just ridiculous. It has a 102 kilowatt-hour battery, delivering roughly 580 to 620 kilometers of CLTC range. Plus, it's powered by a dual-motor, all-wheel drive system pushing out 697 horsepower. Wow, 697 horsepower in a luxury 3-row SUV? That's serious performance. But what about the price tag? Chinese EV makers are famous for price cutting right now. Are they joining that race to the bottom with this one? No, and that is exactly the point. That's the high-margin pricing strategy kicking in. They are pricing the ES9 just above 500,000 yuan, which is roughly 71,900 US dollars. They are designing this specifically to take market share directly from legacy luxury giants like the BMW X5 and massive domestic rivals like the Aito M9. And here is the fundamental key for investors. Luxury flagships carry significantly higher profit margins than budget sedans. This specific vehicle is the key to accelerating NIO's path to actual profitability. Okay, I get that. Higher sticker price, better margins. But the bears will immediately point to the cash burn. Wall Street has punished NIO for 2 years because they spend so much money building out their battery swap stations. How do I justify that capital expenditure when they need to be showing profits? Well, in my opinion, that's the beautiful part of the current setup. Wall Street is still punishing them for the cash burn, failing to realize that the heavy lifting is already done. NIO has successfully deployed over 3,500 battery swap stations. Think about that for a second. This is no longer some slide deck promise to investors. It is a physical, tangible infrastructure moat. Right, because nobody else has a network like that. It creates a sort of walled garden for NIO users. Exactly. It creates massive switching costs and customer lock-in. Once you get used to swapping a battery in 3 minutes instead of charging for 40, you don't want to go back. But financially, this is where the magic happens. I am moving from capex to operating leverage. As delivery volumes scale up, especially with new volume brands like Onvo, this massive swap network shifts from being a capital expenditure drag into a high-margin operating leverage engine. Every new car sold makes the existing network more profitable. So my analysis suggests the market is essentially valuing them like they are still spending billions to build the network, rather than valuing them as a company that is about to reap the rewards of the network they already built. Spot on. And that brings me to the valuation reset and why the bears are exhausted. The easy money on the downside has already been made by short sellers. For 2 years, bears hammered this stock over price wars, China macro fears, you name it. But the valuation is now pricing in pure mediocrity. Because expectations have been pushed so incredibly low, NIO doesn't actually need a miracle to rally. What do I mean by that? They don't need a miracle? I mean, they just need incremental improvement. If they show any positive surprise in deliveries, or even a slight margin expansion from the ES9, it will force a massive re-rate. Analysts will have to compress the risk premium they've attached to the stock, sending the valuation multiple much higher. It's a classic setup where bad news is priced in, but good news is completely ignored. Okay, I'm tracking with the fundamentals. The business looks solid, the product lineup is strong, the infrastructure is built. But fundamentals can take years to play out. Let's talk about the technicals. What is the chart telling me right now? Because I mentioned extreme pressure earlier. Yeah, while the fundamentals give me the long-term thesis, the technicals and the options market tell me when this move might actually happen. And right now, the chart is coiled like a spring. Let's look at the dominant price action. NIO is showing undeniable relative strength lately. It has surged 14.22% over the last 1 month alone. That is not just retail traders buying a few shares. That is systematic accumulation. 14.22% in a month is definitely notable. Where am I sitting regarding the key moving averages? A lot of algorithmic trading is based on those lines. The moving averages are creating what I like to call a golden floor. The stock is currently trading right near the 5.30 level. What's critical is that it is completely holding above both the 50-day moving average, which is at 4.87, and the 200-day moving average, which is sitting at 5.22. And for the newer investors listening, why is that 200-day moving average so important? Holding above the 200-day moving average is a textbook, universal signal of institutional support. It separates a long-term downtrend from a new macroeconomic uptrend. When a stock reclaims that line and holds it as support, institutions start treating it as a buyable asset again. Furthermore, if I look at the momentum, the relative strength index, the RSI, is sitting at a really healthy 63.77. So it's strong, but not overbought yet? Precisely. An RSI of 63.77 indicates strong, undeniable bullish momentum, but it still has plenty of room to run upward before it hits that 70 level where things traditionally become overextended. The technical foundation is incredibly solid, but the real fireworks, the real pressure cooker, is over in the options market. Let's get into that. The derivatives market usually tells the real story. What are the options chains showing me? The options market is heavily skewed to the upside. It is a glaring indicator that the smart money is positioning for a major breakout. First off, let's look at the overall put/call ratio. It is sitting at a highly optimistic 0.67, meaning there are way more calls being bought than puts. Yes, a ratio under 1.0 means traders are overwhelmingly buying calls, betting the stock will go up instead of betting against the stock with puts. But it's not just the overall ratio, it's where those calls are placed. I have an ultimate battleground forming right at the 5.50 level. Okay, 5.50. What is so special about that specific price? There is a staggering wall of open interest there. I am talking about nearly 38,000 call contracts sitting right at that 5.50 strike price. That is a massive resistance level, but it's also a magnet for the price. Meanwhile, right below me, the 5.00 level is heavily defended as support, with over 12,000 call contracts acting as a floor. So price is trapped between a floor at 5.00 and a ceiling at 5.50. What happens if it breaks through that 5.50 ceiling? I mentioned a squeeze earlier. In my view, if it breaks 5.50, I get into the mechanics of a massive squeeze, and it's a dual-engine squeeze. I have a 30-day implied volatility currently sitting at 65.45%, alongside heavy daily volume of around 35 million shares. The stock is primed for a volatile, upward momentum loop. Explain the mechanics of that loop. How does it actually play out on the trading floor? It starts with dealer hedging. As smart money buys all those upside calls, the market makers, the dealers who sold them the contracts, take on massive risk. To hedge their own books, the dealers are forced to go into the open market and buy actual NIO shares. As the stock price moves closer and closer to that 5.50 wall, that dealer buying accelerates mathematically. This is often called a gamma squeeze. Right, so the dealers are forced buyers. But what about the short sellers? I said they were exhausted earlier. Exhausted, but also complacent. This is the short covering fuel. The short sellers have gotten so used to NIO fading every rally that they haven't closed their positions. If NIO breaks 5.50 and that forced dealer hedging aggressively pushes the price up to, say, 5.80 or 6.00, those short sellers are suddenly deeply in the red. They will be forced to panic buy shares just to close their losing positions and stop the bleeding. So I have dealers buying to hedge, short sellers buying to cover, and retail jumping in on the momentum all at once.